Hi, today's topic is expert witness status in business valuation matters. There is a great injustice going on in the legal world today, unchallenged. The legal industry bypass their own standards of expert witness status and endorse so-called experts without checking their fitness for purpose. According to the High Court of Australia in Placer-Dome Inc. case in December 2018, accounting methodologies have been rejected as being a reliable indicator of value. The High Court has rejected balance sheet approaches such as top-down or bottom-up, discounted cash flow, the income approach, and future maintainable earnings, and also the application of a multiplier. Accountants call it an industry average without market proof. Expert witnesses should or must have educational achievement or sufficient training and experience to offer expert opinion. And they should declare when an issue is outside their field of expertise. But this does not happen. The accounting industry do not have business valuation training or experience, and their methods have now been rejected by the High Court of Australia. Accepting a business valuation from an accountant is like asking a nurse to perform an operation. They may have seen plenty, but they lack the knowledge to prevent complications. It is nonsensical. Valuation should be left to those who know how to value all assets, both tangible and intangible. To write a report without training and call it a valuation is fraudulent. Accountants are not trained in valuation techniques. In fact, they have no idea how to value tangible assets such as inventories, plant and equipment, property rights and interests, and their own standards declare that they have no idea on how to value intangible assets such as goodwill. Why do they do it? They know they don't have the training, yet they seek to mislead you without declaring their lack of competence. The accounting industry state in AASB 1013, goodwill is the future benefits from unidentifiable assets. What utter hogwash! According to this, the accounting industry cannot even identify what goodwill is. They claim goodwill is unidentifiable, and they do not know what the future benefits are. When you do not know what creates goodwill, or there is no consensus whatsoever on what it is, how can you claim to understand it or value it? They do not meet the criteria, and their own reports are not based on current market evidence. The golden rule of valuation: if you can't prove it, don't use it. Now, every judge, QC, SC and solicitor that have accepted accounting reports instead of real valuations have denied their clients natural justice and have erred in maintaining a high standard of expert witness status. My advice to anyone who has suffered loss due to an accounting report claiming to be a valuation is to sue for compensation. It is time to challenge every so-called expert, both by their status and training and the content of their reports. Their reports and contents can never be proven. They are merely an opinion. Given this statement, it is time to attack their credibility. They may have had 30 years' experience, but that is 30 years of getting it wrong. Challenge their knowledge about goodwill and markets. Don't let them get away with misleading courts anymore. Now, let's have a look at what they do. If you have a look at the illustration on your screen, it's pretty much self-explanatory. All values and variables, such as multipliers, must come from markets. And what markets are doing today, not what occurred 20 years ago, and not what is predicted into the future. Therefore, if there are no markets, there is no value. The coronavirus should have taught you that. Every report based on the following: EBITs, EBITDAs, future maintainable earnings, balance sheets, discounted cash flow, or WACC, or multiple values. You are dealing with someone who has no idea. If markets disappear, so does value. These reports are not based on market activity, full stop, even though they claim so. Let's provide the proof that is needed to throw such reports in the bin or attack them at law. The High Court has rejected them, so should you. All valuations must be based on the law, but these are not. They are based on accounting and taxation concepts which have absolutely nothing to do with markets. They record prices paid, which are never reconciled back to market values. Now, this is the methodology they use. There are a few variations, but basically, if you study the diagram on your screen, this is why I say always attack the contents of their reports. Ask them where they got their multiplier from. How did they come up with your return number? And what did they use to create it? Ask them where the valuation of the plant and equipment is. Ask them when they inspected the business and asked where the comparable sales are. Then asked when they valued all items in the balance sheet instead of accepting written down values. Then ask them where they were trained in valuation techniques. Then ask them when they read the lease and compared rentals. In fact, the list of questions will go on and on. Now, particularly for the legal industry, there are three main High Court decisions, or one a House of Lords decision, that provide guidance to the valuation of businesses. The first one, the House of Lords decision in the matter of Muller in 1901, whereby Lord Macnaghten stated that goodwill value must come from a source. And he went further to say that it is the attractive force that brings in custom. It comes from a source and it can be identified and measured. It is not and never will be the rearrangement of expenses. Sales is the only number that is provable. Sales is proof of interaction by the business with markets, but they must be sales with margins and they must be transferable. This is what is missing in nearly 99.9% of reports. If the report is not based on sales, it is rubbish. The Australian High Court decision in Spencer's case in 1907, whereby it was held what constitutes market value. Values must come from markets, not the practice of rearranging expenses based on accounting knowledge. And the latest High Court decision in Placerdome in 2018, finally, has rejected accounting concepts of goodwill valuation. It has rejected them based on unreliability. Finally, some High Court justices got it right. Their reports, or the accounting industry reports, are unreliable, unprovable, and misleading at law. To value any business, you must be trained in the ability to value tangible assets as well as intangible assets. And to do so, you must get your information from the marketplace. If you are valuing properties or rent, you must investigate the property market to determine values. If you are valuing vehicles, you must study new car sales, used sales and auctions to determine value. If you are valuing plant and equipment, you must investigate plant and equipment markets to understand them. And if you are valuing stock or inventory, you must investigate suppliers to determine value. And if you are valuing goodwill, you must investigate sales achieved in the marketplace to value such. You can have the greatest idea or product in the world, but unless you can sell it in the marketplace and create margin, you have no value. All assets or components of a business must be valued as at the date of valuation. All tangible assets must be valued at market value, and all intangible assets must be valued based on the sales achieved in the marketplace, not the rearrangement of expenses or creating a false return and the application of a guess multiplier. But this is what has been accepted in the past by all the top QCs, SCs and judges. But how do accountants qualify as valuers? They have never been trained. So where did this magic happen? If you are not a teacher, you are not a teacher. If you are not a judge, you are not a judge. But how have they been able to fool you all? All values must come from markets based on sales, and there is only one market value, not differing values as suggested by some. Go back and read their reports. They'll have 2 or 3 multipliers in them. All sales occurring in the marketplace will either be above the line or below it, and it's best explained as a buyer paying a premium or obtaining a discount. I have attended lectures in the accounting industry whereby most hold the view that there are many values and it depends on who is buying, which will alter the price or value. They claim that if a buyer comes from the same industry, they should pay more for economies of scale or synergistic benefits. What utter stupidity. Market forces dictate values. If a buyer is to get the benefits, why should they pay more to someone who is forced to sell? It does not make sense. They try to invent values, but if they are not supported by markets, they are a waste of time. Markets change, and you must change with them. Markets change all the time, but most analysts have been using the same multiplier for the last 30 to 50 years. How can their reports be right? Therefore, protagonists that produce reports based on the rearrangement of expenses, such as EBITs, EBITDAs, future maintainable earnings, discounted cash flow, is without logic or reason. They ignore the source of revenue streams, and they always seek to create an artificial return that is not based on market numbers. They create an artificial return which is misleading, therefore fraudulent. They know no other way. Anytime an analyst uses discounted cap flows or cap rates in a business valuation report, it is recommended you attack it. Cap rates should never be used in business valuations. If you cannot value a business on today's numbers, you will never improve your valuation by trying to predict the future. Discounted cash flow is not a predictor of value. At best, it is a budgetary tool. Always attack where they got their future value from. It is complete rubbish in business valuation because earnings and expenses are not robust and predictable, such as property returns. You can never prove income or growth rates, nor the interest or risk rate, and you can never prove the expenses or occurrence dates. The world needs a valuation method that can value any asset or any business on any day, week, month or year, and it must be based on provable numbers, not guesswork. If judges want the truth, then they should reject inferior documentation rather than endorsing it. To prevent future problems, solicitors should always ask for 2 valuations. 1 for tangible assets at today's value, and 2, 1 for intangible assets at today's value. Thank you. That concludes today's presentation. All of the above can be found at valuationworld.org, and I hope you get your copy of my book soon. Thank you very much.